Hello there. Thank you for joining us today. I'm Marcia Butler, the webinar director here at Advice Chaser. We want to welcome you as you're coming into our room today. Before we introduce our guest and get started, I need to do a little bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting, are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. We're thrilled to bring you today's educational presentation. Attendees are muted, but we do encourage you to ask questions in the chat box. I'm going to go ahead and turn that on, so that is working right now. The presenter will answer those queries during or after the webinar today as appropriate. If you ask a question in the chat box, go ahead and leave your phone number as well. And if we can't get to your question during today's event, we'll make sure someone reaches out to you to handle that question. We want this experience to be as educational as possible, so please don't hesitate to ask for clarification or expansion of the material, to put your comments in the chat. Really, we're here to address as much as we can. And if you have a question that you want to get out of the way right away, feel free to put it in the chat and we'll try to weave that in as we go along. I'd love to introduce you to our presenter today. Jeffrey Costa is a portfolio manager and certified financial planner who crafts comprehensive financial plans and investment strategies for his clients. Jeff joined Schultz & Company in 2020. He specializes in holistic financial planning as well as managing his clients' portfolios to meet their short-term and long-term goals. Prior to Schultz & Company, Jeffrey worked at First County Advisors as a trusted investment officer for 4 years, and he began his career in financial services as a financial planner and investment advisor representative at Barnum Financial Group, an office of MetLife in 2009. He has taught on-site financial education in multiple Fortune 500 companies as part of MetLife's Plan Smart program. Jeffrey holds a BA in economics and political science from the University of Connecticut and has been a certified financial planner since 2017. Well, Jeff, I'm excited to get into this one. Lots of people have questions about rollovers every time we do this kind of topic. And so I know you want to be inclusive on this and talk about different kinds of rollovers for different vehicles. So I'm going to let you get started.
All right, fantastic. Thanks for having me again, Marcia. So this is always a hot topic. It's, I've been doing this for about 15 years or so now, and everybody always has questions about rollovers. I think there's just so many different types of retirement plans. A lot of them end up getting treated similarly, if not the same. But now with the addition of Roth IRAs and Roth 401ks and all kinds of after-tax vehicles or after-tax contributions in these type of vehicles, it just adds a little bit of complexity to the whole game. But the idea today is to simplify that and give you some good guidance and kind of the pros and cons of why you might want to consider a rollover, when to do it, how to do it, and answer any questions along the way. So with that, let's jump into kind of the basic discussion of what is a rollover. As the name likely implies, it would be rolling over your 401k, 403b, 457 type plan through an employer and moving it to another retirement account. Because it's called a rollover and not a distribution, that denotes that it is not a taxable event when done properly. So when you're moving to like plans, And rollovers can be done both from traditional 401ks to traditional IRAs, and from Roth 401ks now, which have become more widespread, into Roth IRAs at their most basic level. You can do some traditional 401k to Roth IRA moves, but that would then ultimately be considered a conversion, and we can talk about kind of what that means and the implications of that as we go through. So let's move on. So let's start with the why. So why would we want to do a rollover? So the first thing we talk about is simplicity. So oftentimes over a working career, people tend to build up a bulk of their wealth in their employer-sponsored plans. And over time, especially in this day and age, people tend to bounce around from employer to employer, not necessarily every year, every 2 years, but over a career of anywhere from 30 to 50 years in some case. Ultimately, most people end up with at least a few employers during their lifetime. And so as a way to consolidate those assets and have them just in more of an easily investable bucket, not having to look at multiple places, doing a rollover into an IRA or a Roth IRA in some cases, but most commonly it's moving from traditional 401ks, 403bs, 457s into an individual retirement account, an IRA. And again, the goal here is to just consolidate and have everything in one place, because even when people have two plans, I often see they say, "Oh, do you ever look at your old 401k?" Or "Oh, well, maybe once a year, sometimes every 2 years," and they typically look at their current plan a lot more often, and so it becomes a problem, especially with market volatility, as things change, as your asset allocation needs change, to not lose sight of those plans, particularly when they have a fair amount of assets in them. The next reason to do this would likely be because of control. When you have assets at a former employer, you only have so much control over really the investment choices. You're only kind of dealt a handful of options. So these days, it's very common to have a bunch of different target date funds. And usually a large cap fund, mid cap fund, small cap fund, an international, and a couple of different bond funds, maybe a fixed interest account if they offer something like that. If you decided to do a rollover into an individual retirement account, traditional or Roth, now that opens up an entire universe of investment options that you can choose from. You could buy individual stocks, you could buy individual bonds, you could buy a brokered CD inside there. You could buy, in some cases, if you do it right, you could even buy gold. Not that I'm recommending doing that. It's a little complicated, but you can do that. There's even opportunities to buy real estate in IRA. It's not as common, but you can do those things should you decide to do that. And, with good conversations with an accountant along the way, an advisor. But you really, the world is your oyster. You can really kind of customize those things as much as you like. And also, which we'll talk about in a little while, it also allows, if you want someone else to be able to manage it for you, because either you don't have the time, the background, or just the desire to do it, that allows you to have a third party, an advisor, or just like an institution generally, be able to watch that for you and be able to take care of it and keep an eye on it. Then there's also cost savings potentially, and this is when I want to spend just a minute or two on, because I feel like most people don't really dig into the underlying expenses on a 401k, 403b, 457, et cetera. Most individuals, if you ask them how much they're paying in their 401k plan, either think it's free and they don't pay any fees, or they just, say, "Oh, I know I pay something, but I have no idea." And the answer is, it really varies based on the type of plan you're in, the size of your employer, what type of investment options you have available. Kind of the rule of thumb is that the larger the plan assets, in the total plan at your employer, the lower the administrative fees and things like that, because they can scale it and have it be, spread over a very large number of employees. As an example, if you have a plan with $1 million of assets total, which is not very much for an employer group, you could be paying upwards of 2%. And some different studies that kind of looked over all these different plans and said, well, what's the average for plans of different sizes? And it could be anywhere from 1.5% to 2% of assets. And the areas that are included in that number, by the way, are investment fees, administrative fees, individual service type fees, and custodial fees. So all those different line items kind of make up that total headline number. And then at the lower end, you could pay 0.5% in fees total for plans that are like huge employers with $1 billion plus of assets. So it really, really depends. But the key takeaway is that, nothing is free. It's just whether or not you see it. And I think that being able to understand that and essentially look at it as it's more of a level playing field when you compare it to an IRA, than just assuming, oh, I don't want to move it because it's more expensive to go into an IRA. It can be, but it's not necessarily less expensive or more expensive. You just need to do your homework. And like anything in life, it's what are you paying for and what are you getting for that money? Fees in the absence of value, fine. But if you feel like you're having it well managed and you have peace of mind and it's just overall in a better place long term than potentially moving to an IRA where, yes, you're going to pay likely some fees, whether it's a custodial fee alone, where you just pay a basic, $100 or $200 to an IRA provider, and then you self-manage. You might pay some very small trading fees if you were to do it at like an online brokerage, or if you worked with somebody who is, buying mutual funds for you and charging an asset under management fee on an annual basis. You can be, in a similar percentage to what some of these 401k plans are. It just really depends. But again, I think you just want to understand what your goal is with the management of your plan, how involved you want to be, and just do your homework. I would just say that IRAs are more transparent with their fees. You typically know what you're paying, and it's easier to find that out instead of having to dig through, hundreds of pages potentially in a prospectus in a employer plan and having to seek it out versus just being able to look at a statement and saying, oh, this is my annual fee. And you're done.
I had a question here. I'm assuming that this is something you could go to your advisor about and say, hey, can you look and see what I'm paying in fees?
Yes.
Because they can read that probably a little easier than the average person.
Typically, if you are able to get by law, you're required to get those documents provided to you by your employer if you request them, or if you pull them down from like your online portal. You should be able to find those. And if not, you can ask your HR department and they can point you in the right direction. But your advisor certainly could help kind of do a side-by-side of what that would look like. In the past, I've had experience where I've worked with firms where we could offer 401k plans. And so we would have a whole team devoted where we would get all that data, bring it to a pension plan administrator who would go and essentially search for the best provider based on the size of the employer group, what type of funds they were looking for, and then put a proposal together to an employer so they could do a side-by-side and make that decision. So all the data is there. You just have to know where to look and how to interpret it in some cases. So as we mentioned before, the different vehicles that you can roll over: 401ks, which everybody's pretty familiar with; 403bs, which are typically, teachers have 403bs, other institutions, public institutions sometimes have 403bs. 457s, again, a lot of kind of government workers typically have 457s, and there's different types of 457s. And depending on how they are funded, whether it's pre-tax or after tax, again, where they can be rolled over to may vary. but generally speaking, it's all the same type of stuff. So there's not a huge amount of difference. The key takeaway when you're trying to figure out where to roll your money to, and again, it's always good to do this with the help of either an accountant or an advisor, just to make sure you don't run afoul and end up with a surprise tax bill. But you just need to know where you can roll it to, what type of account. So where can I roll it over to?
That's exactly where we're going there,
Yeah.
Jeff.
It's almost like we planned it.
Almost, yeah.
So where can we roll to? So any traditional 401ks or 403bs, those can be rolled right into a traditional IRA because they're pre-tax contributions. They grow tax deferred. When they come out, they're taxable as ordinary income. So it's basically the same type of wrapper. Again, there are nuances in the rules, but generally speaking, for tax purposes, they're treated pretty much the same.
So just a question here. So that means that we're going from a traditional account to another traditional account, and there's not going to be any tax implications, correct?
Correct.
Unless you're making withdrawals at the same time.
Yes. So as long as you're keeping it within a retirement plan, as long as you don't take the money and put it in your bank account, your savings or checking or whatever, a non-qualified account, there are no tax due. There's no tax due. So, and then with a Roth IRA, you can roll from a Roth 401k. If you have that option, you may have some dollars built up in that portion. And then, a lot of people these days have a split where they can say, oh, I want to do half of my contributions into traditional, half into Roth. You would just do 2 rollovers. Essentially, your provider would split it into 2 checks, deposit one into your traditional IRA, the other one would get deposited into your Roth. It's pretty straightforward. The third alternative, which sometimes people will do if they, typically if it's a smaller plan balance at an employer, or they just really like the options in their new plan and they want to self-manage at the new employer, you can roll an old 401k into a new 401k. And when I say 401k, that's shorthand for 403b, 457, just so I don't have to say it that many numbers that many times. So just to clarify. So that works. You can just move like to like, and you don't have to worry about any tax implications there. The thing that I would say with that, and what I caution people before they do that, is once you roll it into that employer plan, you are now beholden to all the rules of that plan. And so now you can't roll that money out unless you have a qualifying event, which would be either you separate from service from that employer, or you reach 59 and a half, and then you ultimately decide to do a in-service withdrawal. And you can roll that to an IRA at that point. So next up, if you're self-employed, you could move it into your own retirement plan, such as a SEP IRA, solo K, et cetera. This one, you want to make sure that, again, you talk to a qualified professional plan administrator, for your retirement plan, to just make sure that everything is okay and you don't run afoul of anything. The next piece, you don't have to do a full rollover. You can elect to do partial rollovers. So it's not, oh, well, I have to do everything or nothing. You can, if you have 100,000 balance, you can take 10 grand, you can take 90 grand, whatever you want to do. Your administrator may have some minimum dollar amount, but generally speaking, the IRS doesn't have a, opinion around, the exact dollar amount or percentage. If that makes sense. Okay, so we kind of already hit this one, but when can you do a rollover? So you need to have a qualifying event to leave the plan. And in this case, it's either you leave your employer, or if you're over 59 and a half and you're still at the employer, you can elect to do what's called an in-service withdrawal. So this is an option that a lot of folks tend to do as they're getting close to retirement. If they've built up a lot of money in there and they're working with an advisor, and they say, I would really like to have my advisor be able to manage this because, I've been working with them for a while and, I trust them. They have better options than I have, but I also want to be able to contribute to my plan still and not lose a match or anything like that. And so if you decided to do an in-service withdrawal for all or part of that money, it doesn't preclude you from continuing to contribute to that plan. So that's a good option. Then last but not least here of this group, provisions from, we have a little bit of an update here with the law that changed towards the end of the year from the provisions of the Secure 2.0 Act, which we just did a webinar on not long ago. So feel free to check that out. We'll plug it. And so an issue that the IRS and a lot of other plan administrators and legislators have become aware of is that when employees who had smaller balances in their 401ks would leave a job and they'd move to the next employer, then they would have essentially an option to cash out, which a lot of people took, or they would be able to roll into an IRA. The problem is that a lot of people didn't know how to do it, or they didn't respond in time. And so the plan administrator would automatically kick out a check for the plan balance. And what happens is you have a tax liability, and then you also lose the tax deferral on those dollars that you can never get back again. So you lose the compounding on those dollars for the foreseeable future. And so it's a way that the government is trying to encourage people to not lose out, and for younger people and people with lower balances to encourage them to stay in a tax deferred vehicle and do that. So they're setting up kind of the framework to make it as easy as possible, so it just happens automatically. So we'll move on from there. Okay, so how many times can you do a rollover? So the IRS says that you can only do a rollover really from a 401k once a year from the same account. And so what is ultimately confusing to a lot of people is they think of, if you have an IRA and you want to move it from, say, Schwab to Fidelity, and then you decide, I hate them, I want to move it to a different place, you can move it more than once, but what you're doing is called a direct transfer, custodian to custodian. It's not a rollover. So you can do more than one move to different plans. It just can't be a rollover per se, which most people wouldn't do anyway. So that one, just I want to clarify that, because that's something that, again, a lot of times people say, well, if I move it, then I can't ever move it again. You can move it. It's just what we call a direct transfer, where you don't get the money, which is what you wouldn't want to do anyway. The money you want to go directly to the new institution, and then we can, move on from there. So, okay, so what will I need for a rollover? So this is pretty basic. You just need your current retirement account info. You'll want to figure out how much you would like to roll over, and then where would you like it to go? I typically would recommend that if you've never done a rollover before, to either work with the new sponsor where you're sending it to, so you can get all the information from them, so they know where to send it, because sometimes you have to send it to the overnight address and not the regular address. And you want to have all the appropriate ways that your check needs to be made payable, have your new account number ready. It's always good to have your advisor on the line if you have an advisor. It just makes everything much easier. You don't have to worry about having any issues and then having to back it out later down the road. So it's not complicated, but it's like anything. If you're not sure about the right terminology, it's just easier to have somebody who's been there and done that, and you can get that moving as quick as possible.
I know for a lot of people, at least in my experience, a rollover, it's maybe one of the first reasons why you would engage with an advisor and start working with them. Is that correct? Is that something that you found too?
Yes, definitely. I mean, a lot of times people say, I'm leaving my employer and I am looking for advice on what to do with this money. And they may talk to a couple different providers, and then ultimately they say, okay, well, I'm going to go with Jeff, and let's figure out this rollover situation, and then we facilitate that transfer, either the advisor or somebody in the office who handles the transfer process. It's pretty straightforward, but it's usually 10 minutes on the phone.
It's usually
you also spend more time on hold with some of these large companies than the actual process takes by far.
Well, we're getting some questions in. I know we have one more slide before questions. So
Perfect.
Go ahead, let's round this out and then let's go to questions.
That sounds great. Okay. So what tax implications to expect? You want to ask your advisor, make sure that it's, as you think it should be. So make sure it's going, traditional 401k to traditional IRA. If you're not doing that, make sure you understand if it's a conversion, if you're doing a Roth conversion, because the IRS now eliminated the ability to do essentially a do-over on a Roth conversion, or a recharacterization was the term, where you could undo that within a certain period of time. Now, once you've done it, you can't undo it. And so a lot of people would roll over into, convert their traditional IRA or 401k into a Roth, and then realize that when they got to tax time, their accountant's like, yeah, this is not a good year to do this. You ended up having a lot more income than we thought initially. So let's reverse it, and then we can do it another time in the future. Now that is no longer on the table. So you have to be really careful and understand what you're doing prior to executing that move. Okay, so let's see, tax implications kind of talked about, but generally speaking, if it's done like to like, there's no tax implication. How it fits into your overall plan. Again, it's really, what are you trying to accomplish by your rollover? Is it, simplicity? Is it cost cutting? Is it control? Or a combination of all these things. Make sure that you truly understand the implication of that. And again, if someone's going to manage that, what does that look like going forward? But, and then what would be the best time to do a rollover? So I would argue there's really not any time that's necessarily better than others. I often see a lot of people do their rollovers when they have a triggering event, which is when they're either laid off, or they retire, or they just change jobs and realize that they have this extra plan. And so it really depends, but there's not like a time that you have to do it, because the employer plans allow you to keep the funds in there. They don't usually kick you out. Although I have seen situations where companies have been bought out by another company, and they told all non-active employees that they needed to roll their funds out. I had that for a client who was in their 70s and just was like, oh, the plan's fine, and kept it there. And then they told him, well, you can't keep it here anymore. So he's like, well, I guess I need to roll it over. And I guess you do. So, it really just depends.
All right. Well, we're going to go ahead and get into questions, and we've gotten several in here. Keep them coming, folks. We'll try to answer as many as we can.
Sure.
So this is a good question. What is the process for an automatic rollover of a 401k when leaving a job? I'm not sure exactly if that question is worded right, but if you can talk about automatic rollovers, I'm not sure what exactly they mean.
So, yeah, I'm not sure if they're referring to the new legislation with the automatic portability, because, based on my research thus far, it's not necessarily determined yet how that will work. It sounds as though there's a group of some of the largest employer plan sponsors that have set up kind of like a clearinghouse. So as it sounds today, which may change and how the framework comes together, they will be kind of identifying automatically if you're an employee who was at a Fidelity plan and now you pop up on the radar of a new employer who's on, say, Schwab, and they're interrelated, they share data, they can say, oh, we see John Smith is over here now. And based on this threshold with negative consent, if the person doesn't respond, they will automatically move those funds to the new employer plan. That's my understanding of how that will work. It's still kind of it's still new, so
Yeah,
we
it's
really
new
haven't seen this happen.
legislation.
We haven't really
So,
seen it yet.
okay, so you're assuming this is maybe how it's going to work, but we're not 100% sure
That's
yet.
based on some of my reading of industry discussion and
Okay.
what they've seen, how it's been proposed thus far.
But that's no guarantee. So
No, and it sounds like the person will have the option to do something else. So it's like if they don't respond, it's like then they'll go down this rabbit hole, assuming they find them in this database. If not, they'll potentially freeze the funds in the existing plan, and then from there, it's still TBD.
Okay. All right. So how much will a financial advisor charge on a rollover service?
So financial advisors don't charge for a rollover service. So it's usually just part of getting an account funded. So if you decide to work with somebody, that's just part of the getting assets over from one institution to another. Like as an example, if I'm working with a client and they say, "Oh, I want to roll over my old 401k," we'll set up our new account. That's typically an IRA, and then we will do a call with them, or sometimes I'll do a Zoom with somebody and just do a screen share just to help them go through the appropriate prompts, make sure they title the checks and everything looks good, and then all that goes into the employer. They mail the check, we get it to our custodian, and so on. But there's no fee to do that. Anything is usually just part of the asset under management fee, or however you're structuring with your advisor to work with them. That's not like a separate line item charge that people I've never seen anyone charge to do a rollover.
Okay, and definitely that's a good question to ask your advisor if you if you don't know.
Yes.
All right. If you were laid off and don't yet have a new employer, is the money parked in your, can money be parked tax-free until you get a new job? So for example, you have a 401k at your old employer and you're laid off. What happens there?
So generally you can keep it there for a while, if not indefinitely. Again, if the balance is under 5,000 currently, and I believe it's going up to 7,000, that's when those new automatic portability provisions would go into place. But in the past, people left their 401ks at old employers forever, basically. Nobody, unless the plan had a provision, like I said, where there was a takeover of a prior company where they sent everybody notice saying you got to take your money out. Generally, you can keep it there for a while. There's not like a specific amount of time that's by statute, so you can keep it there. I would say if you're laid off and you have a decent balance, and you want to be more active with the money, have more options, or you have an advisor that you want to work with, then the rollover option is probably a good fit. And you can go from there, but it's not that you have to do it usually right away.
So a follow-up question to that is that, can you keep on contributing to that account if it's at the old employer's custodian?
So while it's still in the old 401k plan, you cannot, because it's the only way 401ks and the like can be funded is via payroll deduction. So you can contribute to an IRA, and which most people do if they're either unemployed or self-employed, or you can do both depending on your income, or you can do a 401k up to the match. And then you can say, well, I'd like to contribute to my IRA, especially if it's still deductible, up to the limits that are allowed, and then you have more control. So it really depends on the situation.
All right, thank you. Here's another question. You mentioned to be able to withdraw from a 401k from an employer. I'm not sure. I'm going to have to reword this one just a little bit. Let me go to another question and then I'll come back to this one. What if you want to take a cash distribution from funds in one of these accounts during a rollover? What does that look like? Is there a penalty?
So a lot of that depends on your age. So if you're over 55 for a 401k versus 59 and a half on an IRA, you typically can take funds out, but you do have to pay ordinary income, assuming it's not a Roth or after-tax contributions. So you will pay tax, ordinary income tax at whatever your rate is. So it'll just get added on to your W-2 income for the year, any of your total income for the year. There are qualifying events that will allow you to avoid penalties, because typically it's a 10% penalty for those that don't have a qualifying event or trigger, if you will. So you can take money out. It's just that you will definitely pay tax, assuming it's not a Roth or after-tax contributions. And depending on if it's after-tax contributions, if it's the basis or the earnings, because earnings get treated like pre-tax money, because those $10 have never been taxed before. So it really depends on the type of money that you're looking to withdraw within those plans. And also, and kind of an interesting thing while we're talking, and I meant to bring it up, but kind of we got sidetracked here. You can roll over from one plan. You can do a rollover and split it into multiple checks depending on the type of contributions. So as I mentioned before, you may have traditional IRA, or I'm sorry, traditional 401k, 403b contributions. Mm-hmm. Those are always pre-tax. As I mentioned before, that's the most basic. Those will always just go to a traditional IRA. Then you have the Roth contributions. So if those are after-tax money, you can send those right to a Roth. However, if you have after-tax, which are non-Roth after-tax, because prior to a few years ago, a lot of plans didn't, there weren't really Roth 401ks. The alternative, if you wanted to save more money in an employer-sponsored plan, is they would allow sometimes for after-tax contributions. And so the mechanism for that, it was similar to Roth in that it would be money that you already paid tax on. The earnings would grow tax deferred. And the money that was after tax, again, when you left, your basis was tax-free. They would just have to kind of separate it. It wasn't technically a Roth. So you can move after-tax amounts to a Roth IRA now because it's the same after-tax treatment. So you can move that money, and then any of the earnings from those after-tax contributions would then go through a traditional IRA. Does that make sense? Hopefully.
Yeah. So basically, you're looking at you're separating the different wrappers, like you said, or exactly. The different types.
Yeah.
Just so that there's no tax implications there.
Yeah. And then one other piece too, if you are doing a rollover and you have, those different kind of buckets of money underneath that account, you can split where those after-tax contributions go, as an example. So if you said, I want to send 10,000, say you have 20,000 of after-tax money, you can send 10,000 to a Roth. But if you said, I'd like to have 10,000 in my checking or different account that's not a retirement account, you can move those into a different type of account. You don't have to send all of one type of tax bucket to one account. Like, you can split some of those up. So just to, make sure people understand there is a fair amount of flexibility. You just have to make sure that you are like teeing that up correctly and making sure all your checks go the appropriate places, and you work with a professional, especially when you're getting a little bit more complicated.
All right, I'm going to attempt this other question, and I will tell the person who put this in there if I'm not saying it correctly. Go ahead and write another comment and correct me, please. Okay, so you mentioned that to be able to withdraw from a 401k at your employer, you have to be so many years close to retirement, something like that. They weren't exactly sure how many, and they weren't sure if you needed to be at the employer a certain number of years or not.
To roll over from a plan?
Not to roll over, but to be able to withdraw
Okay.
funds from the plan. So maybe you can talk about that age requirement, and also if there's if there's a number of years in the plan requirement, I guess.
Sure. So to be able to take money out of your 401k, it's really age driven. It's not years of service. That's really something age of service is really only a function like pension plans, typically, of kind of the crediting, investing, and things of that nature. You may have years of service issues for the vesting of employer contributions and of your match. But for any money that you put in, there's no time limit on that type of thing. The caveat would be for a Roth, where sometimes there's limitations of like being able to take out earnings prior to 5 years in the plan. You have to leave it in. However, that said, you can usually always take your basis. So whatever you put in, you can take out. So I would just say that any money that you put in, you basically have access to immediately. There are maybe tax consequences, but you can take it. And it depends on what type of original tax treatment, whether it went in pre-tax or post-tax, for how that plays out for tax purposes.
Yeah, and I'd say that's a definite reason why you would want to talk to a professional. Make sure you didn't do that right or don't do that wrong. I'm assuming you can't walk that back once you've done it.
Yeah, it's usually pretty hard to do that. The one thing I will say, which is kind of an interesting concept, is the 60-day rollover, which a lot of people don't kind of talk about. Is it's kind of a planning back pocket if you need money, but you don't want to pull it out from a plan for a long term. You can essentially roll your money out, give it to, you could cut a check to yourself. Depending on your plan sponsor, they may require you to do mandatory withholding of a certain percentage. But as long as you put the money back within 60 days, it doesn't count as a taxable event. It's really, they count it as a rollover. So where I've seen this used is like if somebody knows they have, a big chunk of money coming, but they need some cash sooner, and they don't want to have to take money out of their retirement account and get hit with a penalty, they can essentially give themselves a loan for 60 days, put the money back, and then they have the other money to replenish it when, whatever. But like people sometimes will do that when they're buying a house, and if they need funds to float between, buying and selling. So if you have to close on your new house before you close on your old house, it can be an opportunity from a planning standpoint. Again, done within the right supervision. And you can usually only do that once a year, right? It's one rollover per year. But you can do a 60-day rollover to yourself and give yourself basically a tax-free loan.
Very interesting. I've never heard of that. That's again something I wouldn't attempt without an advisor myself.
No, it's like kind of the joke, without adult supervision, you may end up with a big tax bill, but like that's something that we have used. I've, considered using it for myself when I recently was in between, like for house closings. You're like, oh, why did the attorney sends you the thing? Oh, by the way, you need an extra 10 grand. You're like, oh, okay.
Oh, wow.
How do I avoid a tax bill if I need to sell something, So it can be a good option. I've done it for clients who had a tax payment, like income tax, and they were like, oh, well, as soon as I get my next pension check or Social Security, I'll be fine. So I'll just put the money right back. But if you're in a time crunch, you can get your money in a couple of days and then put it back. So
very interesting.
Anyway, just kind of a little nugget there. And again, just something to be aware of.
All right. We did have a question about, I'm nervous about getting scammed or having someone, like, for example, an advisor stealing my money if I write a check to them for a rollover. Can you talk a little bit about
absolutely
being, being safe?
Yes. So first off, always do your due diligence on anybody you're going to work with. But second, and probably most key, is that whenever you're doing a rollover, you're usually writing the check directly to the new custodian. So as an example, my firm, one of our custodians is US Bank. Whenever we do a rollover, all checks are made out to US Bank, and then usually we follow it by FBO, for benefit of whoever the client's name. And then usually in the memo line, we'll have the new account number. So you want to make sure that that check is never made out to anybody personally, which I hopefully shouldn't have to say, but just to be super safe, right? I mean, you don't want to ever make things out to individuals. It should always be made out to the new custodian or company. So because individual advisors they're not allowed to be handling customer funds. That's a big no-no. So it needs to be made directly to the new provider. And again, usually good practice is having the new account number, having it say the new custodian, FBO, John Smith. That's the way you would typically title it. And if you want to be super safe, to Roth IRA and then the new account, just so they put it in the correct account, because I've seen that where they send two checks. It's not clear whether this one's the Roth check or the traditional check, and then they can flip flop it. Ultimately you could get it fixed, but it's a headache.
And that's something not necessarily that's always necessary. A lot of times I know that the advisor can handle that all.
Yeah, correct.
For you, as long as.
Yes. And, just to like with a direct transfer where it's an IRA to IRA, usually the new custodian will send transfer paperwork directly to the old custodian. So you provide a statement for the old one, you sign transfer paperwork, and they basically handle it all behind the scenes and you don't need to be involved. That's much easier. But from an employer plan, you have to call or you have to go online and you have to deal with it manually because the check has to be pushed, not pulled. So your new advisor can't pull the money. It has to be pushed from the old institution via check typically.
Okay. All right. Well, I have time for maybe one more question. This is a little more involved question. I thought it would be a good one to round this out. Okay. Once you've done a rollover, what's kind of the next steps in making sure that that retirement account is either growing or distributed correctly for your retirement? Talked about like how rollovers fit into the overall financial planning process for retirement.
Sure. So again, rollovers to an IRA, it's really just a change in wrapper. So it would really be operating just like your 401k plan would be in your overall plan, right? It's tax deferred money, or in most cases, unless it's like after tax contribution, but generally speaking, talking about tax deferred money. The asset allocation would be hopefully the same or similar to what you had prior, unless you have a big change in your situation or your risk tolerance. But it should again be fairly similar. Just now you may be working with an advisor or just a new firm in general, right? That's going to be managing it for you, and because it's an IRA is not a particular allocation or return profile. It's really just a wrapper. The ability to customize and adjust it is fairly limitless, right? I mean, every person's will be different. There's no blanket statement there. So on this case, it's really more like the logistical issues, the tax issues, with having it in an IRA versus a 401k. So again, that's something that shouldn't change because it's in an IRA based on what you're doing before. It's just that now, hopefully, if you're working with an advisor as part of the overall planning process, you probably have a bit more of a comprehensive plan in place. And now you have, your advisor has talked to you about what that risk profile should look like based on A, what you need, and B, what you can handle from a risk standpoint, because sometimes those are not in line with each other. So again, it's not that an IRA is going to change anything fundamentally with what your planning should look like. It's just that as part of working with an advisor, hopefully they have done this work to be able to like say, hey, this is how the new allocation will look. We'll roll it over and then we'll get it started into that new allocation once the funds arrive.
Right. If you're not familiar with not familiar. I mean, if you haven't been working with an advisor before and a rollover is kind of your first interaction with an advisor, how does that work? Let's say they don't really know anything about their risk tolerance and they don't really know what they want.
Well, and that's the advisor's job, right? And the advisor setting up an account and identifying, you should be having that conversation prior to the rollover. You should know where the money's going, what the strategy is. The rollover is really just the final event of getting it underway. So the rollover itself should be, kind of the last piece before you actually make the investment. You should be discussing with the advisor the plan, the overall financial plan, and at least in my case, if especially if you're handling more than just the investment part of someone's planning, have that discussion. Then you should be talking to the client, should be talking with their advisor about what is their risk tolerance, what can they handle, what do they think they need as part of the planning process. Like if you can retire successfully getting 5% on your money over the rest of your life on average, you don't need to be taking on risk that's commensurate with a 10% return. Somebody might feel comfortable with it, but then there's the conversation of, do they need to take that? Right. And so, those are key discussion points prior to the rollover. The rollover is, okay, now we have the plan in place. Let's call and get it moved over. And then once it arrives, then we start buying and selling whatever we need to do, and getting it up and running.
Very good. Thank you so much. We really appreciate everyone's contributions to the chat and to also the questions. Really good questions today. That's about all the time we have today. And on behalf of the Advice Chaser, we want to thank our speaker and the organizations that have made this webinar possible today. Thank you to our attendees so much for attending. Look for an email soon with a link to the replay of this event. We're getting some thanks in the chat, and
thank you everybody.
It was very helpful. Oh, we got a smiley face too. I like those ones. Here at Advice Chaser, we're all about helping you find a financial advisor who's a great fit for your life and your financial questions. Our matching service is free to you, and every one of our advisor partners has committed to offer a free initial consultation to anyone we introduce them to. Find out more by going to advicechaser.com and clicking on the link to find an advisor. Well, once again from Advice Chaser, thank you so much, folks, for coming. We hope that this was a valuable use of your time, and we hope to see you at another webinar soon. Goodbye, everyone.
Bye-bye.